Happy third day of classes, everybody. Feel like we're already in need of a break. We get one on Monday, so there's that. You get a little bit of a break on Monday. So, um, yeah. So today we are going to kick off our official review of the concepts that we talked about in 417. Slides will look somewhat similar to 417. May I use the same template, so they always look similar, but there's going to be some differences. I will be going a little bit more in depth over some information that relates to non-issuer audit standards. So just as a reminder, I know it's been at least a year for many of you. For a few of you, it's been 2 years. I think a few of you took spring 2024 auditing. Anybody longer than that? Was anybody in fall 2023 that I'm just honestly curious about this. This interesting depth and how detailed, how far back we go. So some of this should be familiar. Some of this should be somewhat new. I am going to be adding a lot of information to the slides. So it's not just all contained in the slides, but I will add a lot of details. So again, I encourage you to take notes wherever you think necessary. The first quiz will be solely over these next 3 lectures. I don't want to tell you that it's not going to cover it in detail, because I will expect you to have some detailed knowledge over this, but it's also not going to be so in depth as what you would expect to be on an exam. So it's going to be kind of a happy medium. So this is kind of setting the foundation for what we're going to be talking about for the rest of the semester. For the most part, I think the whole purpose of these next 3 lectures is so that you have the foundation that you can refer back to if you have questions on things. This will not answer all of your questions on, especially on the CPA prep questions. I'll have to do some research on those, but it should give you a starting point to work from. So let's just go ahead and really quickly, before we dive in, let's go ahead and delineate some things that we need to make sure that we're clear on. So remember, we talked about this back in 417. We talked about there's different sets of standards for public companies or for issuers, and for non-public companies or non-issuers. All right. So what was the name of the organization that sets the standards for public companies? 5 letters. Sounds like peekaboo. PCAOB, the PCAOB, the Public Company Accounting Oversight Board, okay? In fact, if you go into public accounting, they'll actually often call it peekaboo because nobody wants to actually say PCAOB over and over again, but there we go. All right. And for non-issuers, the organization that has oversight, in general, it's the AICPA, but there was a specific standard setting body within the AICPA. Does anybody remember what that one's called? The Auditing Standards Board, the ASB, okay? So the good news is the PCAOB derived most of their original standards from the Auditing Standards Board standards. So this is back in 2002, 2004, when the Sarbanes-Oxley Act was being drafted. The original standards came from the Auditing Standards Board. There have been some deviations and some changes, simply because they do deal with 2 different populations of audit clients. That being said, there's a lot of overlap. So what we're going to be learning is general information, and I will talk about deviations between the 2. That will become especially pronounced once we start talking next Friday, or next Wednesday, I guess it is. Next Wednesday, when we start talking about reporting. We're going to be going into depth a little bit about what is contained with within the ASB audit reports. And then the following Monday, week 3, our first case is actually going to be a dive down into the ASB audit reports. And it used to be really, really nice because the ASB audit reports were very simple and straightforward. They were like 3 paragraphs and they were just simple and sweet. And the PCAOB revised their audit report, and the ASB basically said, hold my beer. Okay. And so, yeah, they kind of went crazy with those as far as all the detail that's now in the reports, which I don't think that they set standards thinking about the fact that new CPA candidates are going to have to learn all this information. But it is a bit of a slog. If you thought the PCAOB reports were bad, just wait. Just wait. Don't want to intimidate you, but there's a lot of information we have to cover, which is why we're doing 2 separate days for this. Yeah, so that's kind of set the foundation. Got 2 different sets of categories. In general, most of our rules will apply to both categories, but we will have some delineations that will occur. So let's talk a little bit about the foundations for auditing. So remember the thing we talked about at the very beginning of 417? I know this because I got to teach it later today, and this exact slide is going to come up again. Talk about principal agent theory. So principal agent theory, what is that? What is the concept of principal agent theory? Has the idea that in an organization, usually a corporate form, okay, the people who own the organization are not the same people who run the organization, for the most part. I mean, you may have executives within the organization that have some ownership of the organization, But by and large, the people who own the organization are separate from the people who run the organization on a day-to-day basis. So what are the principals? Which group do those represent? Is that the owners or the executives? This is the easy questions, guys. So when I get to hard questions, I can, okay. So those are the owners. Yes, those owners. Okay. Who are the agents then? Those are the executives and managers. Okay. Those are the managers. All right. Now, it's important to note that if you are not operating on a day-to-day basis, you probably don't know what's going on a day-to-day basis. So the people who are running the organization on a daily basis, they have a lot more detail about what the true position of the organization is than the people who own the organization. That's a concept called information asymmetry. All right. The people who know or run the organization know a lot more than the people who are not run the organization, which is really, really problematic, because if you're a manager and your incentive is to make as much money as possible and you want to actually have that performance-based bonus, you might have an incentive to, and this is the first time I'm going to say this, but it will not be the last, to cheat or to lie or to commit fraud. Okay. So there's to further that problem, there's a conflict of interest exists. Okay. So if you're a manager, your incentive is to maximize your compensation and to keep your job for the short term. If you're an owner, your incentive is to maximize your long-term wealth. Those do not necessarily always align. That's basically a conflict of interest. The people who are running the organization may make decisions that maximize short-term opportunity in lieu of long-term wealth. An example of this, there was a company that we're going to talk about later on, someone that you're probably somewhat familiar with in passing, called Enron. Okay. That was one that they did really, really well in the short term. In the long term, they no longer exist. Okay. Technically speaking, they no longer exist. I think they exist in some small capacity, mostly as a meme. As far as Enron, yeah, they were really, really good in the short term, and in the long term, they fell apart. So the solution to this, at least the solution that should be, is going to be the audit function. Okay, the audit function is going to mitigate that, and the whole idea is that we serve as mediators between the principals and the agents. That's the way it should work. Now, you're saying Dr. Barnes used Enron as an example. The audit completely failed there. I said, yes, there are exceptions to every rule. In auditing, there's a lot of exceptions to those rules. So we're going to talk a little bit about some of those exceptions over the course of the semester. But it's mostly, if the audit function does its job, then we mitigate this information asymmetry dynamic by basically looking at the company for the principals and saying everything looks good. And we also mitigate the conflict of interest by saying the agents are doing what they should be doing. That's kind of the whole goal of the audit function. So that's the foundation of everything we talked about. That's kind of the theoretical construct that we're dealing with. Let's go ahead and talk a little bit about how we set up that. That's basically, by the way, that's basically the most important parts from chapters 1 and 2 that we talked about back in 417. Everything else important, but it's basically a reflection on what we're going to be talking about moving forward. So moving on to chapter 3 of the book, we're going to be talking about client acceptance and continuous. Okay, so we're talking about new engagements, and this is not the type of engagement we're talking about. I made that joke back in 417 and nobody laughed, and still nobody laughed in this class. There were some smirks, but no laughs. Okay. When we talk about an engagement, there's two possibilities. First of all, we could be doing an engagement for the very first time. That's considered to be engagement acceptance. There's also the possibility of we could be doing an engagement for multiple periods. We could be basically saying, are we going to do the engagement again? And that's considered to be continuance. Okay. So we do need to think about both of those possibilities, acceptance and continuance. And when we are thinking about accepting a new engagement, we need to investigate the new potential client. So this is basically saying we're starting off the ground floor. We need to determine if this is a good idea for us to do the auditing. Now, for the most part, I'd say 95% of the time, we're going to say yes, because as auditors, we are business people. If we don't have clients, we don't have money, all right? And if you're in this room and you're saying, I'm not really concerned about money, Dr. Barnes, I'm going to say it must be nice to be you, all right? But for the most part, we do need to have clients, so we're going to be pretty loose in our considerations. But there are going to be situations where we say, we are not accepting this client, there's too much risk. So what are some things that we need to do? There's a long list of things that we're going to talk about. One of the most important ones that we're going to discuss in this course is how we talk to the previous auditor, if there is one. So the whole goal is to understand what is the reason for the new client requesting a new auditor. Sometimes this is going to be a little bit devious and deceptive. If the previous auditor says, yeah, this client's a mess, they were trying to do things that were completely and totally unacceptable, and I left. If you're the new auditor coming in, you're probably saying, oh, that seems like a red flag to me, all right? And so that's a possibility. The more likely scenario is there's going to be a logical explanation for why the client needs a new auditor. Maybe the auditor has scaled out. They're too small to actually be able to handle the workings of the new client. The auditor may be retiring or going into a new line of business. Whatever it may be, we need to understand the reason for the change in auditor and changing the auditor. If we're going to be working on a new client, we also need to make a decision whether we want to retain the existing client. Okay, so we want to retain the existing client as well. So one thing I kind of skipped over this, so let me make sure I back up on this. Okay, so what are some things that we need to be concerned about when we're talking about whether we're going to accept a client? Well, there's first thing we probably want to talk about is we're going to talk about the client's ability and integrity. All right. Does the client have the ability to maintain effective financial reporting and financial statements? Are they going to do this in an honest and a forthright manner? So client ability integrity is really important. Also, we need to understand what are our staffing needs as the auditor? Do we have the necessary people to do this? It would be really, really wonderful if a CPA here in Kirksville could actually take on a company like Amazon and say, oh, I'm going to make millions of dollars on this client. Yeah, you make millions of dollars, but you also need personnel that probably don't exist. You probably could staff it with the entire city of Kirksville, and it probably would not be sufficient. So yeah, that's a problem as well. And then the auditor independence issue as well. We're going to talk a little bit about the code of professional conduct over the course of the semester, but keep in mind that independence, in fact, and appearance, really, really critical for audit engagements. Also, we're talking about whether we're going to acquire the predecessor auditor. One of the things that we would like to have from them, if possible, is we would like to get a hold of their working papers. Now, when I say working papers, does everybody remember that term? That's just a fancy term for audit documentation. The documentation that occurred over the course of the audit, if we can have access to that, it makes our job much easier because we have a basis to work from. All right. So we're retaining an existing client. This is just basically asking questions of whether or not we want to continue on working with the client. I would say 99 times out of 100, this answer is going to be yes, for the reasons we talked about. We're a business, we need to have clients. What are some reasons that we may not want to continue on with the client? Generally, these fall in one of two categories, okay? One of this is going to be, the first one is going to be that there's a contentious relationship with the client. We try to do our job and they fight us at every single turn. It just is no longer worth the battle. No longer worth the battle. All right, so that's the first possibility. Second possibility is going to be that there's a dispute about audit fees. They do not want to pay us what we're worth. We cannot do the job for less than a certain amount, and they were not willing to pay that amount. So disputes about audit fees can come up as well. So assuming that we come to an agreement, whether we're going to accept the new client or continue on with the new client, we're going to issue something called the engagement letter. And this engagement letter was something we talked about in 417, we alluded to multiple times. This is just a contract between the auditor and the client that outlines each party's responsibilities and their accountability for the engagement. Okay. So what are the important things we need to know about engagement letter? Well, the engagement letter contains a lot of different sections. But for the most part, there are three things that you need to be aware of, or three sections that you need to be aware of that should be in every single engagement letter for an audit engagement. The first of all is going to be the objective of the audit, which is pretty straightforward. It's usually to present or to test the financial statements to provide reasonable assurance that they're free from material misstatement. There's also some elements of internal control, especially if we're talking about public company audits, but for the most part, it's just the financial statements. We also need to outline the auditor's responsibility. And then the third section is going to be outlining management's responsibility. So let's go ahead and check and make sure to see that you got the remembrance of this, okay? So when I say the preparation and presentation of the financial statements, is that an auditor responsibility or a management responsibility? That is a management responsibility, preparation and presentation of the financial statements. When I say the evaluation of the financial statements, what is that? Is that a management responsibility or the auditor responsibility? Technically, you could make an argument for both, but in this context, we're talking about the auditor responsibility, okay? For the design, implementation, and maintenance of internal controls, is that a management responsibility or auditor responsibility? Management, good, okay? We're talking about the evaluation of internal controls. That's going to be technically both again, but in this context, the auditor responsibility, okay? So we need to make sure we understand all the differences there. There's also a minor issue that we want to make sure we're clear on when we talk about management responsibility. They do need to provide auditor with access to all relevant information and personnel that they need to complete the audit. So that's a minor issue that comes up, but for the most part, we're talking about financial statement and internal controls responsibilities. All right. So we go into the engagement. We're going to be working on the engagement. We're going to be testing internal controls. We're going to be gathering evidence. And we are going to do all this on our own as the external auditor, right? Because we don't need anything from the client. We have borne this responsibility all on our own. If you guys were existing back in 2005, that would have been the answer, okay? If we were going back 20 years ago. If we went back in the past, yes, the answer would have been, yep, we do this all on our own. We can't rely on the client for any of this. Fortunately, we're 20 years in the future. We're more enlightened now. We've got things like AI and the internet. Actually, I had the internet back in 2005, so I don't know where I'm going with this. All right, so what am I talking about here? So the point that is that we're going to do a lot of work as the auditor, but we want to rely on the client as much as possible. And to some degree, that's going to be part of our testing of controls. Because remember, controls are those things that are created by the client to make sure that they mitigate risks. And we'd like to rely on those controls to some degree. But at a more basic level, we can rely on client personnel. And if we can rely on client personnel, that helps us get a lot more assurance in our role as the external auditor. So we want to know if we can use the work of the internal audit function. Now, remember, the internal auditor, that's a group of individuals that work for the client. We as the external auditors are external to the client, but we know that there's a body that works for the client that also provides their own set of assurance. They are there constantly, as opposed to us that's only there for a period of time every single period, okay? So they know a lot more about the inner workings of the internal or the client, the internal operations organization. So they probably are going to be very, very good, a good resource for us. That being said, if we want to use them as a resource, we have to, as the auditors, have to check and make sure that 3 characteristics exist, okay? First of all, probably the most important one is they need to be objective, okay? They need to be objective. They need to be free from basically free from influence of the management team in their responsibilities. If they're not objective, they can't do their job independently, then we can't really rely on their assessment. Secondly, still critical, but not as critical, is going to be the competence of the internal audit function. They need to understand what their job is doing. If we come in and it looks like that they have no clue what's going on, we're probably not going to place a lot of assurance on their assessments. And the third one's a little bit weird. This is the application of a systematic and disciplined approach. That's a lot of words for basically saying what they do makes sense. Okay, it's an intuitively sensible process. All right. So a lot of the parties that we need to be accountable to and these things that we're going to be talking about. So we've already talked about management. We've talked about a representative of management, which is going to be the internal audit function. Those are all parties that we're going to interact with auditors. But we also need to interact with parties that are called those charged with governance. We're going to see that term a lot. When we talked about it for the PCOB, we talked about a very specific party. When we talk about it for the ASB, it could be a number of different parties. So when I talk about corporate governance, who are we generally talking about? What group within the organization? So corporate governance, if we're talking about corporate governance, we're talking about the people who have oversight of the executives, okay? And there's a subset of a big party, the subset of the shareholders that are charged with corporate governance. What is that group called? The board of something. The board of directors, okay? The board of directors are those charged with governance. In many situations, as auditors, there is a subcommittee of the board of directors that we have accountability towards, okay? They are also those charged with governance, specifically governance related to the audit engagements. Does anybody remember the name of that group? A committee of some type. An audit committee, yes, the audit committee, okay? The audit committee. So what is the audit committee, all right? What is the audit committee? Audit committee is a subcommittee of the board of directors that is responsible for the financial reporting and disclosure process, okay? They are responsible for the oversight of the audit engagement. Also, as a note here, I want to make a note here. This is something we did not talk about at 417, but I think it's important to toss this note here in, is that the audit committee is responsible for approving the engagement letter, which again is the contract between the management team and the auditor. The audit committee has to review that and approve the engagement letter, which makes intuitive sense that they would, but we didn't actually specifically mention that back in 417. So according to Sarbanes-Oxley Act, Section 407, there are some rules relating to audit committee composition. So the audit committee has to be comprised of certain individuals. Now, there's 2 things that you probably need to remember about this, 2 critical details. The first one is they need to be comprised of outside independent board members. Now, this means that they have to be on the board of directors, but they cannot be employees or compensated individuals of the organization. Now, when I say compensated individuals, use a loose term on that. Usually board of directors do get compensated for their time, but they cannot get additional compensation beyond that time that they spend board of directors. So if they get additional compensation for other services, they cannot serve on the audit committee. The only compensation they get relates to their responsibilities as board of directors and members of the audit committee. So employees like the CEO, CFO cannot serve on the audit committee. That's a big violation of 407. The other critical detail is we need to have at least one financial expert. Not everybody on the audit committee needs to be a financial expert, but at least one person does. Financial expert is basically somebody who has served in a financial position in at least one annual financial statement audit. So usually that's going to be somebody who's worked as a controller, a CFO for at least one period, right? Now, we've established what the roles are. We've established those. So we're at the point right now where we're in the planning phase of the audit. Now let's just do a quick review, okay? Remember we talked about the different phases of the audit. The very first phase of the audit is going to be the planning phase. And the planning phase can construe a lot of different sub-phases. Technically speaking, when you talk about the planning phase, there's also a subset of the planning phase called risk assessment. We're going to talk about that momentarily. I personally like to delineate planning from risk assessment because I think they serve two different functions. But technically speaking, they are part of one big function. Once we get past risk assessment, then we get into tests of controls, whether or not these tests to take place, okay? Then we move on to substantive procedures. Substantive procedures is where we do kind of all of our concluding testing. And remember, substantive procedures can be part substantive analytical procedures and substantive tested details. Then we have closing procedures, and then we have the issuance of that audit report right at the end. And we're going to kind of walk through those procedures as we move through. They're not necessarily in that exact order. That's the order of the sequence of the process. So when we talk about this step, we are in the planning phase, which is the very first step. And the planning phase is exactly how it sounds. We are setting the tone about how we're going to conduct the rest of the engagement. During the planning phase, there is very little in the way of evidence collection or any assurance gained. All that we're trying to do is trying to say, here's our requirements, here's what we need to do to meet those requirements. The reason I bring this up, and again, this is going to be something that I say a lot throughout the semester, because my assumption is that many of you will be sitting for the CPA exam, is that when you see a question like this that relates to the planning phase of the CPA exam, the very first thing you should say is, I need to remember I am in the planning phase. I am in the planning phase. If I'm in the planning phase, there are only certain things that I can do. Part of that does not include evidence collection. It does not include contacting certain parties. It is just basically trying to make a determination of what will occur in the future. So this is something that we've highlighted a lot in the past, and it's something we're going to see a lot in the future. You will see questions on this in our CPA prep. But the planning phase is distinct on its own. It is basically creating a plan. That's why we call it the planning phase. So in the planning phase, we're going to do something called creating the audit strategy, okay, the audit strategy. And there's a little bit of difference when we talk about the audit strategy and the plan. The strategy is basically the overall approach to the audit. The plan are going to be the specific steps to accomplish that strategy. Now, they are related, but they are also separate in nature, okay? Now, can you kind of think of them synonymously? As long as you can think of both components, yes, okay? As long as you think about what is the overall objective and what is the step to accomplish that objective. So what are the things that we need to understand in accomplishing the overall audit strategy? First of all, we need to understand the scope of the engagement. Now, for most of our engagements we're going to talk about in this course, this is actually pretty straightforward because we are talking specifically about a financial statement audit. And in a financial statement audit, we have very specific requirements. We have to make sure that financial statements are free from material misstatement, and in many situations, the controls are designed and operating effectively. Okay, those are going to be some of our objectives in accomplishing, and those are what outlined in the scope. The scope will be reiterated, by the way, in the audit reports because there's an entire paragraph that talks about what is the scope of the engagement, and these statements reiterate this idea of what the responsibilities are of the audit. Then we need to plan the timing of the audit. We need to understand what is going to be, when are the things going to take place, when are the procedures going to occur. There are a few things that we need to discuss about this with respect to timing. Now, first of all, timing is going to be reflective of whether we need to do everything at year end versus whether we can do some work at interim. Do you guys remember the terms interim and year end? Some of you may have some experience at doing internships, and some of you may have done some interim testing at year end. So what's the difference between interim and year end? When we say the word interim, interim basically means we have not completed the period over audit. We are at some point in the middle of that period under audit, but we're still doing some testing. Year end basically means, or period end would be more appropriate, especially if we're talking about not necessarily audits for a year, but period end or year end, whichever the term may be, means that the period has ended and we are doing testing over a historical period that has completed, okay? Now, logically speaking, if I wanted to gain the most assurance and I was going to do one of these two procedures, either interim or year-end, which would I choose? So remember, assurance basically is the most confidence that I can have. I want the most confidence in my assessments and my testing. When am I going to select to do testing during interim or year-end? Year-end, okay? Why do I want to do testing at year-end? Because everything's completed, everything's concluded. I have all of the information I need, okay? Now, what is the reason that we might do stuff at interim? It's the same reason why we don't do one final exam and only one final exam in these classes, is because that would just be an overload of work. Imagine if you had one exam and it occurred during finals week, how stressed out you would completely be if that was the case, okay? Has anybody ever encountered a class like that? That would just be misery. I had one class like that, and it was absolute misery, by the way. Yeah. So, yeah. Yeah, that's something we have to consider, is that we don't want to stress ourselves out. So we want to spread out the testing to some degree. There's also another element of timing we need to consider, okay? Let's assume that we want more assurance in a particular procedure. Okay, assume we want more assurance. We're concerned about the validity of testing in this area, or the validity of client assessments in this area. So we want to make sure that we have as much assurance as possible. Is there a relevant argument to say that we would do surprise testing of the clients, that we would not announce when we're going to be going and visiting a particular site, that we're just going to show up and say, show us your inventory? Yes, that's a cruel thing to do, okay? It's like a pop quiz, okay? But can we agree that a pop quiz would actually give the largest piece of information about your knowledge at a given point in time? All right, with that being said, everybody pull up a piece of paper. I'm joking. All right, I'm joking. No, we're not doing a pop quiz. The idea being is that if we do not announce what we're doing in advance, then we've got a much better signal of what the true state of a particular situation is. In fact, a lot of frauds that have occurred have been because people knew when they were going to be audited and what the procedures were going to be. And so they were able to manipulate the situation. So timing is relevant in that regard as well. We also need to determine the focus of the audit team's efforts. We're not going to go we're not going to go too much in detail about this, because focus is going to be mostly dictated by scope. If we know what the scope of the audit is, then we need to know what the focus is. But focus can actually be specific to a particular engagement as well. So say, for example, does everybody remember back in 417, we talked about a company called Earthwear Clothiers? We did a lot of work in that. What was the nature of that particular organization? What was their business line? They were an inventory retailer. So can we say inventory is a relevant area of testing for that particular company? Yes. So does that mean that inventory is relevant for every organization? No. If you have an audit, a company like KPMG or PwC, they would have very minimal inventory testing because they're a service organization. So the nature of organization also dictates the focus that we're going to be dealing with. We also need to discuss about how to identify related parties. Okay, so a related party is anybody who has an existing relationship with a client. That could be a familiar relationship, like a relative of an executive or somebody who owns the organization, or it could be just a close relationship, a close interaction, like business relationship. The concern about related parties is that they do not exist at arm's length. Okay, and we talk about arm's length. The detail I talked about back in the day was a handshake. Okay. When you're at arm's length, okay, you're dealing business with somebody who you don't have a relationship with. You can conclude that relationship with a shake your hand, okay? Now, let's say that you're doing business with a family member. Are you going to shake their hand at the end? Like, yes, we're very formal in my family, Dr. Barnes. Yes. So you're going to do business with a family member. You're going to say, oh, that's great. Thanks. Give me a hug, okay? Yeah. That's closer than arm's length, okay? So if we're at closer than arm's length, there may be concerns that the nature of the relationship is not representative of a traditional business relationships. So we as auditors have to make sure that any related party transactions or related party relationships exist are disclosed in the financial statements. And we have to scrutinize those very carefully, because those tend to be very, very key points for audits. Then we also need to establish materiality, which everybody remembers materiality, but we're going to go into a little bit of detail because it's one of my favorite things to talk about. All right, so what is materiality? Materiality is defined as the amount that is large enough to affect decisions by a reasonable user of the financial statements, okay? Now, that is important to note, because this is going to depend on a client-to-client basis. If I ask you, is $1 million a material amount, what is your answer? What is your answer for every accounting question? It depends. It depends on the client that I'm talking about. If I'm talking about Greek Corner Euros down the street, they probably don't make $1 million in a year, so that would be a very material amount. If I'm talking about Walmart, that's probably a drop in the bucket. They're like, we don't care. Pass on further testing. All right. So in understanding how we're going to assess materiality, we need to consider both materiality at the financial statement level, which we call planning materiality, and materiality at the account level. Now, I want to make a note of this. The way that we characterize materiality at the account level in 417 is called tolerable misstatement. You do need to probably make a note here in your notes for further moving forward, because we're going to see this a lot in Becker. The AICPA likes to call this performance materiality. Now, they don't mean anything different. They're just a different term, okay? The tolerable misstatement and performance materiality are the same thing. Basically, these just represent a materiality at the account level. So why do we think about these differently? Well, consider overall materiality is basically saying this is the concern that we have for the overall financial statements. If the overall financial statements are misstated by a certain amount, then we think that they're not free from material misstatement. Usually this is a much larger number than something called tolerable misstatement, okay? Tolerable misstatement or performance materiality, as I talked about, that term performance materiality. This is usually a much smaller amount, and it's basically an allowable amount of misstatement to an individual account or disclosure. Now, the amount that we actually assign to tolerable misstatement will vary, and the procedures are not necessarily going to align to what we talked about in 417. This is actually something I learned last semester. I actually talked with a partner at KPMG about how KPMG is currently assessing materiality. And it was much different than how we did materiality back in 417. And that's because materiality is not subscribed to a one-size-fits-all rule. All right. So what we did in 417 was completely legitimate. That does not mean that's the way that KPMG currently does it. And if you go off to work in a public accounting firm and it's not KPMG, you may do something completely different as well. So this is the point in time where I'm going to say, if you go back and review the stuff we did in 417, it may not hold in practice. The things that we're going to have to talk about here is not the practical steps to assessing materiality, but the conceptual considerations here. Because at this point right now, we're at a much higher level. We need to say we need to be adaptive to different considerations. So what are some things that we need to talk about? Well, let's go ahead and talk a little bit about the considerations with respect to materiality. So how do we determine planning materiality? The answer is we're going to make a percentage of a basis of a specific account within the financial statements. Now, does anybody remember what our base account was? Our general starting point was back in 417. This is a good one. So yeah, this was called pre-tax income or earnings before income and taxes, okay? Or sorry, yeah, pre-tax income or earnings before income and taxes. Pre-tax earnings. So basically, this is going to be usually our starting point for most organizations. That being said, it's not always going to be a good place to start for every organization, particularly if we're talking about a not-for-profit. Would pre-tax income be good for a company that does not generate income? Probably not, okay? So we may want to use something like revenues or assets. So it's going to depend on the nature of the organization. So like every good accounting question, the answer is it depends, okay? How do we determine natural tolerable misstatement at account or disclosure level? Okay, so how do we determine what the maximum amount of performance materiality is? The answer is it's going to depend. It's going to vary on there's different considerations. I'm not going to give you the kind of the guideline that we talked about in 417. The answer, though, is going to be how large is the account and how active is the account. If it's a larger, more active account, then generally we're going to assign more tolerable misstatement or performance materiality to the account. If we consider that it's going to be a risky account, we may assign less to that particular account. Also, something that's considered is something about aggregate tolerable misstatement. So this is going to be a little bit, if you don't remember this, this is going to be something a little bit confusing. So let's talk a little bit about the difference between aggregate tolerable misstatement and regular tolerable misstatement. So the word aggregate, what does that mean? It means everything considered together, okay? So we add all of our tolerable misstatements together. And if you remember from 417, aggregate tolerable misstatement was usually 3 to 4 times our planning materiality. And it was really weird because that didn't make any sense when we talked about it. And I explained it saying the reason that we can set tolerable misstatement in aggregate as 3 to 4 times planning materiality is because we do not expect overall misstatements to occur in every single account, okay? We do not expect every single account to be misstated by the maximum amount. So that's basically why we can say aggregate tolerable misstatement can be in a multitude greater than planning materiality. What factors can affect the determination of a planning? Sorry, I think I said tolerable misstatement. Yeah, tolerable statement or performance materiality. Generally speaking, I consider those to be size, activity, complexity, and risk of the account. Those are not necessarily intuitive directions, but usually if we're talking about something that's going to create risk in an organization, that's going to result in an auditor assessment of lower materiality amounts because we want to address the potential of risk. And what is meant by the strategic assessment of tolerable misstatement? The answer is that it's not necessarily intuitive that everything should go up or down. We want to do what's best by us as far as the risk profile. So we want to make materiality small when necessary, but also we want to mitigate the amount of work that we have to do as auditors. So we'd like to make those numbers big when possible so that we can do less work, which is often a kind of a variety of extremes. Because practically speaking, we'd love to make make misstatement absolutely massive, because that means we have to find fewer errors and we can still be confident. But from a technical standpoint, we would love to we have to make it small enough that it can actually meet the responsibilities of our stakeholders. So finding the particular point in the middle where we actually find the compromise, that is the strategic assessment of materiality. That's where we actually find that point. We'll have some exercises a little bit to talk about that later on. All right, auto risk model. So AR equals RMM times DR. What do those concepts mean? So what does AR stand for? This is the easy one.
Risk.
Auto risk, okay? Does anybody remember what RMM stands for?
Risk and material misstatement.
Risk material statement, very good. It is comprised of two components. Do you remember what those are? IR and CR. Inherent risk and control risk. And then DR stands for
Detection risk.
detection risk. Yes. Okay. Very good. Okay. So this is the relationship that we understand with respect to auto risk. Now, I want to make a note that this is fundamentally different than the categories of misstatements that we talked about. We talked about three categories of misstatements, which were going to be factual misstatements, judgmental misstatements, and projected misstatements. So that may come up a little bit more, but I'm not going to go into much detail on that right now. What we do need to know is when we talk about audit risk and the types of misstatements, those are going to kind of fall within the different areas of risk that we talk about. So let's just go ahead and talk about each of these in turn. So audit risk is basically the risk of expressing a clean audit opinion when the financial statements are materially misstated. So there's a misstatement in the financials and the auditor says everything's fine. All right. That is what we're trying to avoid. That is a downfall. Now, is it possible that there could also be an audit risk where the auditor says that there's a problem when in fact there is no problem? That has existed as well, but that doesn't fall under the purview of audit risk. So those of you who remember from your science classes, say, what about type 1 error, Dr. Barnes? You're talking about type 2 error. And I say, well, you're very, very sharp to remember type 1 error as well, but we're not concerned about type 1 error as much as we're concerned about type 2 error. Type 2 error is the bigger concern, and that's the one that audit risk represents, saying that there is not a problem when in fact there is. And it's characterized by these other ones. So let's go ahead and break these down, all right? Break these down. And we're going to come back to the relationship here in just a second, all right? So what is inherent risk? Inherent risk is basically the risk of misstatement before any consideration of controls, all right? So you go into business as an organization. So we'll say that you go into the business of making cheeseburgers because everybody knows how I feel about cheeseburgers, okay? So going into the restaurant business, you're already exposed to certain risks in the environment. You've got competitors that you have to deal with. You've got food prices. You've got supply chain issues. You've got customers that you have to pull in. All of these risks automatically exist as a matter of you going into business. Once you start business, those risks are present. Those are inherent risks, okay? Those are inherent risks. Those are risks that we cannot get rid of, but we do need to understand how to mitigate to some degree, all right? So before we consider any responses to those risks, we need to understand what the risks are, and they're many and diverse. So we also know that if we're effective in our role, that when we identify a risk, that we're going to respond to that risk. And what do we call a response to a risk? One of my favorite things to talk about, a control, okay, a control. So if we do a good job of implementing controls, then we can address those inherent risks. However, there's another concern. There's a concern that we can have risks related to the controls themselves. So what is control risk? This is the risk that any of these controls will fail to prevent or detect and correct a material misstatement. So our client, I shouldn't say we, but our client implements controls, and the controls themselves are not effective in this responsibility. If that's the case, then we have a problem with respect to controls, okay? We have a problem with respect to controls. That is what we characterize with respect to control risk. Now, what are some areas of inherent risk that we might be concerned about? High volume of transactions, complex calculations, estimates, the environment in which they operate in, a lack of working capital. I'm going through this quickly because I don't expect you to have the list of those, and I'm not going to have you list those out, but I do want to give you that. With respect to control risk, there's going to be a few more that are going to be very, very specific in origin. So when we talk about control risk, we can say the controls do not exist for a specific assertion, okay? So we know that a risk exists and the controls have not been properly implemented to address that particular assertion. We call that a deficiency in design, okay? The controls have not been designed to address a particular assertion in a certain area. By the way, you remember that word assertion. We're going to talk about that more on Friday. We're going to talk about those things called management assertions. But, and then there's a possibility that the controls themselves could be in place, but they're not functioning properly. They're not operating effectively. Okay, the controls are not operating effectively. We call that a deficiency in operation. So deficiency in design and deficiency in operation. Those are the two types of control failures we're concerned about. So it's important to note that last line at the bottom, you will notice that it's underlined and italicized, which must mean it's important. What do we know about the auditors with control over these particular areas? They have no control over them. They cannot set these areas. These are functions of the entity and its environment. The inherent risk is basically whatever the risk the entity is exposed to. Control risk is basically a function of how good their controls are. We as auditors cannot affect those directly. We can affect them indirectly, but we'll talk more about that later. What we can affect is this thing called detection risk. What is detection risk? Okay. Detection risk sounds like a bad thing, but it's actually a good thing. Okay. Okay. So I'll talk about why in a second. So the risk audit procedures will not detect misstatements. Why do I say it's a good thing? Because if detection risk is addressed properly, then we can mitigate the amount of work that we have to do. Okay. So detection risk is a function of inherent risk and control risk. So we go through inherent risk, we test the controls, and we conclude that risk and material misstatement is high. Okay. So if risk and material misstatement is high, that means that our detection risk is going to be inversely related to this. This is what this function tells me right down here. So if risk and material misstatement is high and they're inversely related to risk and material misstatement, that means detection risk is low. Risk and material misstatement is high, detection risk is low. Now, we say risk and material misstatement being low, it sure sounds like a good thing, right? But if you remember from 417, one of the confusing things we talked about is detection risk is a tolerance or an appetite for risk. If we have a low appetite for risk, is that a bad thing or a good thing? That's a bad thing, okay? That means that we have a lot of work to do because we have to address all possible risks that exist. Now let's change the thing. Let's say that this client has immaculate controls and we test the controls and we're happy with them. So risk and material misstatement is low. That means detection risk is high. High detection risk, that is a great thing. That basically means that we can reduce the amount of work that we have to do. And that's basically what's reflected down here, okay? So detection risk is inversely related to the strength, detail, and quantity, or the net nature, extent, and timing of evidence the auditor needs to collect. So we can think about over here, risk and material misstatement is low, detection risk is high. Detection risk is high, we can tolerate a lot of risk in our procedures, which means that we have to do less work. That's what this net over here low means. If we say risk and material misstatement is high, that means that we think that there's a high risk that the client's financials are misstated, which means that we probably have a lot more work ahead of us to do because detection risk is low, which leads us to a net at the high, okay? That's basically how we consider those relationships there. Now, going back here, I do want to make one more note here of the audit risk model. This is what the audit risk model characterizes. It basically says our determination of these factors right here will lead to our eventual conclusion of the amount of work that we have to do as auditors. Now, does anybody remember when we talk about detection risk, what phase of the audit does that usually relate to? Does anybody remember? We talked about the phase of the audit. We talked about planning phase, risk assessment, test of controls, substantive procedures, conclusion, and reporting. Does anybody remember this back in 417? So this usually relates to the substantive procedures, okay? Which makes sense because inherent risk is basically how we would assess risk and risk assessment. Control risk would relate to our results of tested controls. Detection risk would be the next phase, substantive procedures. Now, is that 100% true? No, there's always exceptions to every rule, but for the most part, that's the way to think about it. Also, what do we know about audit risk in most audit engagements? I told you basically over here, I said detection risk is inversely related to risk and material misstatement. Is it fair to say it's directly related to audit risk? That would be a correct statement, but there's a caveat to that. If you remember back in 417 when we talked about this, I said audit risk is always going to be low or lower, low or very low, all right? Which means that audit risk is effectively a constant. It doesn't change. So even though it has a direct relationship, we're not concerned about the relationship between detection risk and audit risk, simply because this very rarely changes to any discernible degree, okay? Going to always be low or lower, so basically that relationship is not relevant. The most relevant relationship is risk and material misstatement and detection risk, which those are inversely related to one another. All right. Real quick, we're going to talk more about this on Friday. But remember, when we talk about risk assessments, risk assessment is the first point in the audit where we can gain what we call assurance. Now, remember, I characterized assurance a little bit earlier as confidence in the client's assessments. Okay. So we are, over the course of the audit, are gaining assurance, and we have to actually get to a certain point where we're satisfied that we have enough assurance that we can make an assessment of the client's position. All right. The very first step in which we actually gain assurance or we gather evidence is going to be in audit procedures during risk assessment. And there's four categories of audit procedures we can perform here: inspection of records and documents, observation, inquiry, and analytical procedures. Specifically, these are called preliminary analytical procedures, which we'll talk more about analytical procedures on Friday. But why do I mention this now? The answer is that we're going to be talking about gathering evidence and the different types of evidence we can gather during certain phases of the audit. During this phase, we do not have a lot of access to client information. We are just assessing risk at a very, very high level. So the amount of or types of work we can do are going to be limited. Also, it's important to note that we have these three types of evidence right here. Now, this is going to be a bonus point. Now, let's say a brownie point. Yeah, not a brownie point, because a bonus point implies it's going to affect your grade, which it won't. A brownie point to anybody you can remember. What's unique about these three types of evidence right here? Does anybody remember this back in 417? So these three types of evidence are unique in the fact they can be used during any phase of the audit. So if I come up with a question later on during the semester and I say, give me three types of evidence that can be used during this phase of the audit, you don't even need to pay attention to which phase of the audit I asked you about. You can just say inspection of records and documents, observation, and inquiry. Okay. Now, we're going to go in more detail what these represent, but I want you to remember these three because these three will always be important in every phase of the audit. Also, with respect to types of misstatements, what are two types of misstatements? Well, we talked about misstatement categories earlier. This is a little bit outside of the area that we're talking about with respect to factual, judgmental, and projected misstatements. These are more related to misstatements that occur in the financials. So you have unintentional, which are errors, and intentional, which is fraud. Now, in auditing, we're going to be talking about two primary categories of fraud, which is going to be different for forensics, okay? Because in forensics, we're going to have multiple categories of fraud. But we're going to be focused on two primary categories, which is misappropriation of assets and fraudulent financial reporting, okay? So misappropriation of assets is theft. This is usually employees or customers who engage in this. When we talk about fraudulent financial reporting, these are going to be management, okay, that actually misrepresent the financial position of the company and the financial reporting to external stakeholders, all right? Just as a quick note, which one of these is usually larger in scope? Which one of these, if a fraudulent incident occurs, is usually larger in occurrence? Theft or fraudulent financial reporting? Fraudulent financial reporting by a factor of about 10 to 100, okay? So much larger. Also, categories of fraud that we're going to talk about in forensics, we're going to also talk about corruption, but we're going to leave that out of this particular course because it's not as relevant to fraud and financial reporting. The last slide that we want to talk about. When we talk about fraud risk factors, we talked about this yesterday in forensics, and I mentioned fraud risk factors. That's characterized by a geometric symbol. Does anybody remember that geometric symbol? It's a triangle, specifically the fraud triangle, okay? The fraud triangle is characterized by pressure, opportunity, and rationalization. We're going to look at a lot of this back in forensics, but in this course, we're going to be focused on one aspect of the fraud risk factors, which is the one an auditor has the most control over. Opportunity. Opportunity is the one that we're going to focus on because this is the one that we have the most control. We can actually affect other people's opportunity to commit fraud. We can't really affect pressure or rationalization. All right, that's a good review. We'll be back again on Friday for more. See you then.